Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Real estate crowdfunding lets everyday investors put money into big property deals. It's quickly becoming a popular way to invest that doesn't involve traditional stocks or bonds. You're effectively pooling money with others to buy properties you couldn't afford alone. Platforms like Fundrise and RealtyMogul lead this new approach. They make it easier to access real estate investments by breaking down barriers that once kept most people out. We'll explore how these platforms work and what they offer. What is real estate crowdfunding? Real estate crowdfunding offers a modern way to invest in property, different from buying a house yourself or investing in a large commercial building directly. It brings together money from many investors, big and small, to fund real estate projects. Think of it like this: instead of one person buying an entire apartment complex, hundreds of people contribute smaller amounts, and together their money buys that complex. This makes real estate investing more accessible. This approach differs significantly from traditional real estate investing. Historically, if you wanted to invest in properties beyond your own home, you'd need a large sum of money to buy a rental property, a commercial building, or participate in a private equity fund for real estate. Those options often involve significant capital, hands-on management, or deep industry connections. Crowdfunding changes this by fractionalizing ownership, meaning you can own a small piece of a much larger asset. Accredited versus non-accredited investors. The world of investing often separates people into two groups based on their wealth and income: accredited and non-accredited investors. This distinction plays a big role in what types of investments you can access, especially in real estate crowdfunding. The financial criteria for being an accredited investor are set by the Securities and Exchange Commission, SEC. Generally, you qualify if you meet one of these. You have earned income exceeding $200,000 individually, or $300,000 with a spouse, in each of the 2 most recent years, and expect to maintain that income level in the current year. You have a net worth over $1 million, either alone or with a spouse, excluding the value of your primary residence. You hold certain professional certifications or designations, like a Series 7, Series 65, or Series 82 license in good standing. Historically, most private investment opportunities, including earlier forms of real estate crowdfunding, were only open to accredited investors. This was largely due to Regulation D of the Securities Act, which allows companies to raise capital without registering with the SEC if they sell mostly to accredited investors. The idea was that accredited investors have enough financial sophistication and assets to handle the risks of less regulated investments. However, things changed with the introduction of Regulation A+. This regulation, part of the Jobs Act, created a path for companies to raise money from non-accredited investors as well. Regulation A+ allows companies to publicly solicit investments for offerings up to certain dollar limits, with specific disclosure requirements to the SEC. This opened the door for platforms like Fundrise to offer real estate investments to a wider audience, including those who don't meet the accredited investor criteria. It effectively democratized access to private real estate deals that were once out of reach for most people. How real estate crowdfunding works. Understanding how real estate crowdfunding works helps you see its potential. It's truly a straightforward process that connects everyday investors with real estate projects. You're not buying an entire building yourself. Instead, you're joining a group of investors to collectively fund a property. This pooled money then goes towards various real estate ventures, managed by the crowdfunding platform. When you decide to invest through one of these platforms, you typically start by browsing available projects. These projects are often pre-vetted by the platform's team. You can see details like the property type, location, financial projections, and the expected timeline for returns. Once you choose a project, you commit your investment amount. The platform then takes care of the legal structure, property acquisition, and ongoing management. Your returns usually come from rental income, interest payments, or profits from the property's sale. Types of real estate crowdfunding investments. Real estate crowdfunding offers a variety of investment avenues, allowing you to diversify your portfolio. You can invest in many different property types. This choice lets you align your investments with your personal financial goals and risk tolerance. Here are some common types of properties you might find. Residential properties, single-family homes, apartment buildings, often appeal to investors seeking passive income from rent. Commercial properties, office spaces, retail centers, can offer higher returns but might carry more risk due to economic fluctuations affecting businesses. Industrial properties, warehouses, distribution centers, have seen increased interest, especially with the growth of e-commerce. Specialized properties include niche areas like self-storage facilities or healthcare properties, medical offices, assisted living. These can offer unique advantages depending on market trends. Beyond property type, it's essential to understand the distinction between equity and debt investments. This difference impacts how you earn returns and the level of risk you take on. Equity investments mean you gain an ownership stake in the property. As an equity investor, you share in the property's profits, which can come from rental income or appreciation in value when the property sells. This also means you share in the risks, including potential losses if the property performs poorly. It is like owning a share of a company. Debt investments involve lending money to a real estate project or developer, typically secured by the property itself. In return, you receive regular interest payments over a set period. Think of it like being the bank. This type of investment generally carries less risk than equity because your payments are prioritized. However, your returns are usually capped at the agreed-upon interest rate, meaning you don't benefit from any significant property appreciation. Key players in real estate crowdfunding: Fundrise and RealtyMogul. When you look into real estate crowdfunding, two names often come up first: Fundrise and RealtyMogul. Both platforms make it easier to invest in real estate, but they do it in different ways. Understanding their specific approaches can help you decide which one might be a better fit for your investment goals. We will explore what makes each platform unique, from their investment structures to how they source properties. Fundrise. Diversified eREITs for long-term growth. Fundrise has made a name for itself by focusing on its private real estate investment trusts, or eREITs. These are designed to give you a way to invest in a mix of real estate projects without directly buying individual properties. Fundrise structures its eREITs to offer different investment goals, such as generating income, focusing on long-term property value growth, or a blend of both. Now that you understand the basics of real estate crowdfunding, it's time to dive deeper into the key features of Fundrise and RealtyMogul. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.